83% of Americans report being under financial stress. 77% say money makes them anxious. And according to a Harris poll conducted in spring 2025, roughly half of American adults, 53% to be precise, feel like no matter how much effort they put in, something always comes along to knock them back. Here is the part that will genuinely stop you in your tracks. Federal Reserve data released in late 2023 shows that the median American household net worth sits at $192,700. That figure places the typical American household in approximately the top 30% of wealth worldwide. And if you own a home, maintain a retirement account, and have been contributing to Social Security for more than a decade, you are almost certainly holding far more wealth than you have ever actually calculated. You have been measuring your financial life using the wrong ruler, and I am going to show you precisely how. This video is not here to tell you everything is perfectly fine. It is not meant to comfort you with empty reassurance. Some people are genuinely struggling, and nothing said here is intended to minimize that reality. What I am saying is that an enormous number of people watching this very video right now, are wealthier than 80% of their fellow Americans, and simply don't realize it, because they have been staring at the wrong numbers, comparing themselves to the wrong people, and completely overlooking three sources of wealth that never appear in their checking account balance. By the time this video ends, you will know exactly where you actually stand, and the answer will probably catch you off guard. Here is the mental image I want you to carry throughout this entire video, because it explains everything that follows. Imagine you own a store. Every morning you walk in and check the cash register. You look at what came in the night before. You review today's running balance, and based solely on that figure, you decide whether your business is thriving or struggling. You completely disregard the building you own outright, the merchandise stacked on your shelves, the equipment you finished paying off 3 years ago, and the long-term supplier contracts you signed last year. You operate the entire business from one cash register reading. That is precisely how the majority of Americans think about their personal finances. They check the bank account, maybe glance at the credit card balance, and stop there. Everything else, the equity accumulated in the house, the retirement account growing in the background, the government pension they have been funding for 2 decades, remains invisible. It sits on the shelves, but they never bother counting the inventory. I'm going to refer to this as the inventory problem. Keep it in mind every time a new number comes up, because every figure I'm about to walk you through represents something most people possess, but almost nobody actually counts. Let me introduce you to someone. We'll call him Mark. Mark is 47 years old, lives in Ohio, works in manufacturing, and brings home around $72,000 annually. He carries a mortgage on a house he purchased back in 2012. He has a 401k through his employer. He has been paying Social Security taxes since he was 23 years old. And every single month after he settles his bills, he looks at whatever remains in his checking account, maybe $900, sometimes even less, and tells himself the exact same thing. I have nothing. I am one difficult month away from complete disaster. I want to revisit Mark at the end of this video because Mark is sitting on a secret he doesn't yet know exists. Stay with me. In a few minutes, I'm going to show you the most counterintuitive truth about American wealth, a number that completely dismantles the story you have probably been telling yourself for years. But first, let me demonstrate just how distorted the perception gap really is, because it runs even deeper than most people suspect. The Charles Schwab Modern Wealth Survey from 2024 posed a straightforward question to American respondents. What level of net worth does it take to be considered genuinely wealthy? The answer came back at $2.5 million. The average American believes you need $2.5 million to qualify as wealthy. Here is the fundamental problem with that figure. According to the most current wealth percentile data available, you need $11.6 million to enter the top 1%. You need $2.7 million to reach the top 2%. And you need $1.17 million just to break into the top 5%. which means the average American has placed their personal definition of wealth at a threshold only the top 2% of the entire country can actually reach. Everyone sitting below that line, including people who are objectively, statistically, and measurably well off, walks around carrying the quiet conviction that they haven't truly made it yet. This is not a random accident. This is precisely how the human brain processes relative wealth. Behavioral economists describe it as the reference point problem. You don't assess your financial position in absolute terms. You measure it against the people you see around you, the people populating your social media feed, and the lifestyle you have absorbed as the one you're supposed to be living. And in a country where the top 10% control 76% of all wealth, where the reported average net worth is pushed beyond $1 million by billionaires at the very top of the distribution, the internal compass of the average American is completely thrown off. You are measuring yourself against a version of normal that almost nobody actually inhabits, and you feel like you're losing a competition that was never real to begin with. There is a parable I return to whenever I encounter those Schwab numbers. Picture a town with 99 residents, each earning $30,000 per year. Then a single new person arrives who earns $300 million annually. The average income in that town immediately jumps to $3.3 million. Every original resident now earns below the town average. Nothing in their actual lives has shifted. Their rent remains identical. Their grocery bill hasn't changed. Their paycheck is exactly the same. But statistically, every one of them is suddenly a below-average earner. That is the exact dynamic playing out in American net worth perception. The ultra-wealthy didn't simply accumulate assets. They distorted the underlying mathematics so severely that people sitting on $400,000 in assets walk around feeling like they've failed. And here is the aspect that almost nobody discusses openly. The median American household net worth rose 37% between 2019 and 2022 in inflation-adjusted terms. That represents the largest single jump since the Federal Reserve began tracking this data in the 1980s. The middle of America genuinely got meaningfully wealthier, and the majority of those same people still feel financially behind because the reference point didn't shift alongside their actual progress. The Joneses upgraded at the same time. Now here's where the conversation becomes genuinely interesting, because the perception problem is one challenge, but the inventory problem I mentioned earlier is an entirely separate beast, and it is the one actively costing you right now in real psychological and financial terms. Consider what you currently treat as your wealth. If someone asked you this moment to write your net worth on the back of a napkin, what would you include? Most people list their checking account, their savings account, and perhaps a brokerage account if they happen to have one. Then they subtract the credit card balance, the car payment, and whatever remains on the mortgage. The resulting number is usually discouraging, sometimes sitting below zero. But they forgot the shelves entirely. They forgot to count the inventory. The single largest invisible asset on the typical American balance sheet is home equity. And the figures involved are, to use a precise term, enormous. According to the Intercontinental Exchange Mortgage Monitor from March to 2025, the average homeowner currently holds $313,000 in home equity. Data from Totality reporting on the third quarter of 2025 places total homeowner equity for borrowers carrying a mortgage at $17.1 trillion. That is $17.1 trillion of genuine wealth sitting inside American homes that most homeowners never factor into their assessment of their financial situation. And nearly half of all mortgage properties, 46.2% to be exact, are what the industry classifies as equity-rich, meaning the remaining loan balance is less than half the home's current market value. The house is worth twice what is still owed on it. That represents a massive, largely realized asset, and yet people continue walking around feeling financially defeated because their bank account looks thin. At this point, you might be thinking, but that equity is locked up. I can't actually spend it. And that observation is partially accurate. But net worth and liquid cash are not the same concept. A pension fund manager reviewing your defined benefit plan doesn't disregard it simply because you can't access it yet. It counts. It appears on a real balance sheet as real wealth. And in the context of this discussion, when comparing your position relative to other Americans, your home equity absolutely counts. Because the very people you compare yourself to, the ones who make you feel financially inadequate, many of them are also counting their home equity. They simply aren't advertising that fact. Here is a figure that will reframe your entire perspective. Census Bureau survey data from the Survey of Income and Program Participation shows that in 2022, the median renter household carried a net worth of $10,400. The median homeowner household carried a net worth of nearly $400,000. That gap, approaching $390,000 in 2022, is a direct consequence of accumulated home equity. Urban Institute research from 2025 confirms that the median wealth gap between homeowners and renters has reached a historic peak. One group owns inventory, the other group only ever sees the cash register reading. And the group that owns inventory is, by every measurable standard, dramatically wealthier. They simply haven't done the calculation. If you own a home in any form, regardless of how much mortgage balance remains, you are already sitting on one of the most powerful wealth-building mechanisms in American economic history. Not because real estate is magical, but because the combination of forced savings through monthly principal payments and the general appreciation of property values over time has been the primary engine through which the American middle class built financial security across the last 8 decades. The home is not the obstacle. Failing to count it is. I want to pause here for a moment because what I just said about equity you cannot immediately access connects directly to something important. Knowing that your home equity exists is one thing. Building an actual structured plan around when and how to deploy it intelligently is an entirely different challenge. The same principle applies to retirement accounts, your Social Security timeline, and the specific sequence in which you draw down those various asset pools. Years spent surrounded by accountants and tax attorneys who performed this math professionally revealed something consistent. Even sophisticated professionals acknowledge that the distance between knowing your numbers and having a withdrawal system that doesn't collapse in year 5 of retirement is substantial. That's the precise reason a resource called the Exit Code exists. It's an 8-chapter analysis grounded in 50 years of retirement data. Not opinion, not general guidance, but actual mathematics drawn from decades of market return records, withdrawal rate studies, and actuarial research. 2 elements of that resource connect directly to what we're covering in this video. First, there is a section on a dynamic withdrawal method that replaces the 4% rule most financial advisors still teach, a rule originally designed for a 30-year retirement in the 1990s that carries serious structural weaknesses when applied to someone planning an earlier exit in today's environment. Second, there is a framework called the 58% rule, a buffer calculation that accounts for the well-documented reality that a significant portion of early retirees are pushed out of the workforce ahead of schedule, not by choice but due to health issues, unexpected layoffs, or family caregiving obligations. That buffer fundamentally changes the calculation of what you actually need to accumulate. The exit code is available through the link in the description for less than the cost of a single hour with a mediocre financial advisor. Every year that passes without running, this math carries a compounding cost that is larger than most people appreciate. Back to the inventory problem, because home equity is only the first category of hidden wealth we've addressed. The second category is larger than most people recognize. The state of 401 coli participation in America is genuinely puzzling when examined closely. According to the Vanguard How America Saves 2026 report, published earlier this year and based on analysis of 4.6 million participant accounts, the average 401k balance at the end of 2025 was $167,970. The median, which is the more statistically representative figure, was $44,115. Both represent records. Those numbers might initially appear modest, but here's the critical detail most people overlook. That represents just one account. When you layer individual retirement accounts, Roth accounts, defined benefit pension plans, and other retirement vehicles on top of that figure, the complete picture shifts considerably. Fidelity research shows that Gen X workers Those currently between 45 and 60 years old carry an average combined retirement savings balance of $296,252 across their 401k and IRA holdings. For baby boomers, that average climbs to $500,000 or more, and that only captures accounts people can actually see on their phone. This brings us to the invisible elephant occupying the center of the room: Social Security. Most Americans treat Social Security as a vague governmental promise that politicians might eventually undermine. They know they're paying into it. They receive their annual statement and largely ignore the document. That is a significant miscalculation. Here's the correct way to think about Social Security from a balance sheet perspective. If you walked into an insurance company today and asked for a quote on an annuity, a financial product that would guarantee you a fixed monthly income for the remainder of your life, beginning at age 67 and adjusting upward with inflation, the quoted price for replicating the average Social Security benefit would land somewhere between $300,000 and $500,000. That is the actual dollar value of the promise as a financial instrument. It functions essentially as a private pension that the federal government has been pre-funding on your behalf through your payroll tax contributions across your entire working career, and virtually nobody counts it on their personal balance sheet. The Congressional Budget Office formalized this observation in a working paper from 2025 focused specifically on Social Security and the distribution of family wealth. Their conclusion was stated directly: Social Security wealth is more evenly distributed than other forms of wealth, and incorporating it significantly reduces estimates of both the overall magnitude and the expansion of wealth inequality in the United States. Translated plainly, when Social Security is properly added to the balance sheet, the wealth picture improves dramatically for middle-income Americans. But because Social Security doesn't appear inside your Fidelity account and doesn't have a dedicated mobile app sending you notifications, the brain doesn't register it as something real. It remains invisible, sitting right there on the shelves, uncounted and unappreciated. You believe the problem is that you don't have enough money. The actual problem is that you have been measuring the wrong pile all along. Now, this is where the conversation becomes uncomfortable for a different reason entirely, because the case has been building that middle-class Americans are wealthier than their feelings suggest, and that is genuinely true. But there is a layer beneath this that explains why the sensation of financial scarcity persists, even when the objective numbers don't support it. It has everything to do with the benchmark problem, which is the most psychologically corrosive element of this entire situation. In approximately 2 minutes, I'm going to show you a global comparison that will make the domestic American wealth conversation seem almost comically narrow in scope. But first, a point that stays purely domestic, because it represents the psychological mechanism driving everything else. Here is what you are actually measuring yourself against when you evaluate your own financial position. Instagram, LinkedIn, and whatever your most financially vocal friend or family member chooses to broadcast about their lifestyle. The human brain developed in communities of roughly 150 people, a concept known as Dunbar's number. Within that world, the question of how am I doing relative to everyone else was genuinely manageable. You could observe all 150 people directly. You had a real representative sample to work with. Today, your comparison sample is 300 million people, filtered through a social media algorithm specifically engineered to surface the most extreme, the most aspirational, and the most financially dramatic examples of wealth and lifestyle available. Your brain is running the same evolutionary software it ran thousands of years ago, but the comparison group is no longer 150 neighbors. It is every hedge fund manager, lifestyle influencer, and startup founder who posts photographs of their vehicle in a Miami driveway. The underlying software is identical. The input has become 300 million carefully selected outliers. This is precisely why a survey can simultaneously find that 73% of Americans feel financially stressed and that the median American household holds nearly $200,000 in net worth while sitting on $300,000 in home equity. The wealth exists. The perception is broken. And the perception is broken specifically because the benchmark being used is broken. Now, the global picture, because this portion of the conversation tends to make people genuinely pause and go quiet. UBS Global Wealth Report data covering 2024 reveals that approximately 1.55 billion adults worldwide held a net worth below $10,000. Not $10,000 in savings. Total net worth. Everything owned minus everything owed, coming in under $10,000. The total adult population of the planet is roughly 3.8 billion people. That means somewhere around 40% of all adults on Earth have less than $10,000 to their name in total accumulated wealth. Meanwhile, according to that same UBS dataset, the United States ranks second globally in average wealth per adult at $620,000 per person, trailing only Switzerland. But the average is distorted by the same billionaire elevator problem described earlier. Strip out the ultra-wealthy, move to the median figure, and the United States drops to roughly 14th or 15th in the world, with a median individual wealth of approximately $107,739. That is still 14th in the entire world. And it still means the median American individual is wealthier than approximately 80 to 85% of all adults currently living on this planet. If you own a home in the United States, if you carry any retirement savings whatsoever, if you have worked for more than a decade and hold any equity in anything at all, a vehicle you own outright, a paid-off appliance, literally any asset, you qualify as a wealthy person by the standards applied to the majority of human beings alive today. That is not a motivational speech designed to make you feel temporarily better. That is simply what the mathematics shows. Here is the additional layer that completes this picture. Research also shows that 60% of the adults sitting at the very peak of the global wealth pyramid, those in the top 1.6% worldwide with net worth exceeding $1 million, a disproportionately large share of them are Americans. By some measures, approximately 58% of the world's millionaires live in the United States. So we have a country where the median individual sits in the global top 20 to 25% of wealth, where a massive proportion of the world's millionaires reside, where total homeowner equity recently surpassed $34.5 trillion, and where 77% of the population reports feeling anxious about money. That is not fundamentally an economic problem. That is a perception problem dressed convincingly in economic clothing. Now let's return to Mark. Mark, 47 years old, Ohio, $72,000 per year, the man who checks his bank account balance every month and concludes he has nothing. Let's construct Mark's actual balance sheet together. Mark purchased his home in 2012 for $190,000. He put 10% down at closing. He has been making mortgage payments for 13 years. Based on documented price appreciation across Ohio markets and comparable Case-Shiller data for the Midwest region, a conservative estimate puts his home's current value at $320,000. He still owes approximately $110,000 on the mortgage. That means Mark holds roughly $210,000 in home equity. That is the first pile of inventory he forgot to count. Next, Mark's 401k. He began contributing at age 25. His employer matches 3%. He has been a steady, consistent contributor for more than 2 decades. Based on Fidelity data for Gen X workers showing an average combined 401k and IRA balance of $296,000 for that age bracket, assigning Mark a conservative number puts him at approximately $180,000 in retirement savings. That is the second pile. Then there is Social Security. Mark has been paying into the system since age 23. At his income level across 24 years of contributions, his projected benefit at full retirement age would be approximately $2,000 per month in today's dollars. To purchase a private annuity from an insurance company that delivers $2,000 per month for life beginning at age 67, you would need to write a check of approximately $325,000 today. That is the present financial value of Mark's Social Security entitlement as a formal financial instrument. Third pile. Add it together. $210,000 in home equity, plus $180,000 in retirement account savings, plus $325,000 in Social Security wealth equivalent. The total comes to $715,000. Mark has $715,000 in total accumulated wealth. He sits in that same Ohio kitchen every single month, stares at the $900 remaining after his bills are paid, and concludes he is broke. He is not broke. He is simply reading the cash register and ignoring the shelves completely. To be direct about something important, Mark cannot spend that $715,000 tomorrow morning. Portions of it are illiquid. Some of it remains decades away from being accessible. But wealth is not defined by what you can convert to cash this weekend. Wealth is the total accumulation of assets built across a lifetime that provides you with genuine options, real security, and ultimately the capacity to exit the working world on your own timeline and your own terms. Mark possesses those options. He simply doesn't know it yet. Now let me leave you with two specific data points that will remain with you long after the other details in this video have faded. First, the top 10% of American households own 76% of all wealth in the United States. That means the remaining 90% share the other 24% among themselves. And yet, within that bottom 90%, there exists enormous variation in individual outcomes. The difference between landing at the median and reaching the 85th percentile is largely determined by home equity accumulated steadily over time and retirement contributions made consistently across decades. Two habits, not luck, not inheritance, not exceptional income.